Picture the single most unsettling headline the American financial system could ever produce, flashing across every screen in the country at the exact same moment. The nation's largest bank has failed. Not a small regional lender nobody's heard of, not a niche institution serving a narrow slice of the tech industry, but the single biggest bank in America, the one whose name is printed on debit cards in nearly every wallet from coast to coast. Television networks cut into regular programming within minutes. Financial websites buckle under a flood of panicked traffic. Social media fills instantly with a single repeated question that cuts across every income bracket and every political divide. Is my money safe? Meet Sarah, a 44-year-old owner of a mid-sized logistics company in Charlotte, North Carolina, who employs 62 people and keeps her entire operating account, the one she uses for payroll, supplier payments, and rent, at exactly this bank. She has always assumed, the way most Americans quietly assume, that a bank this large is simply too important, too deeply woven into the economy to actually collapse. That assumption shatters on an ordinary Wednesday morning when regulators announce, before markets even open, that the bank can no longer meet its financial obligations and has been placed into receivership overnight. This scenario sounds almost unthinkable, but it isn't unprecedented, even if nothing at quite this scale has happened yet. The largest bank failure in American history remains Washington Mutual, which collapsed in September of 2008, holding roughly $307 billion in assets and $188 billion in deposits, a scale so enormous that the Federal Deposit Insurance Corporation seized the bank and sold it to J.P. Morgan Chase for just $1.9 billion, essentially pennies on the dollar relative to what the institution had once been worth. What triggered WAMU's final collapse wasn't a single bad decision, but a cascading loss of confidence, and the most telling detail is exactly how fast that confidence evaporated. After Lehman Brothers filed for bankruptcy on September 15th, WAMU depositors panicked and pulled $16.7 billion out of their accounts in just 10 days, more than 11% of the bank's entire deposit base gone in barely a week. That kind of speed, an institution hemorrhaging billions in a matter of days rather than months, is the exact dynamic Sarah is now watching unfold in real time, except this time at a bank several times larger than WAMU ever was. A more recent, smaller-scale preview of this same dynamic played out across March and April of 2023, when three regional banks, Silicon Valley Bank, Signature Bank, and First Republic Bank, collapsed within a span of just 2 months, giving the United States 3 of the 4 largest bank failures in its entire history occurring almost back-to-back. Silicon Valley Bank's fall was especially instructive. The bank announced an unexpected $1.8 billion loss on a securities sale on a Wednesday. Its stock price collapsed 60% by Thursday, and it experienced a full-blown run by uninsured depositors that same day, meaning the entire collapse, from stability to closure, took less than 48 hours. Roughly 90% of SVB's deposits exceeded the standard $250,000 FDIC insurance limit, which is exactly why the panic spread so violently once word got out. Regulators ultimately made the extraordinary decision to guarantee every depositor at both SVB and Signature Bank in full, even the portions technically uninsured, specifically to prevent the fear from metastasizing into a broader banking collapse. Economists have a specific term for what happens next in scenarios like Sarah's, a phenomenon officially known as financial contagion, where anxiety about one institution's health bleeds outward and infects confidence in others that may be perfectly healthy. Research examining the SVB episode found that this contagion effect was real but relatively contained, showing up most sharply within the banking sector itself and among closely related financial firms, while remaining comparatively limited across the broader economy, and dissipating within roughly a week once regulators intervened decisively. That's an important nuance because it means contagion isn't some unstoppable, uncontrollable wildfire. It's more like a fire that can genuinely be contained if the right people move fast enough and the public actually believes the intervention is credible. Sarah logs into her banking app that morning and finds only a maintenance message staring back at her. She can't confirm whether Friday's payroll for 62 employees will actually process. She can't pay her fuel suppliers, and her phone starts filling with anxious texts from staff who are asking, entirely reasonably, whether their paychecks are still coming. This is precisely the moment where modern bank resolution machinery kicks into gear behind the scenes, mostly invisible to an outside observer like Sarah. The Federal Deposit Insurance Corporation's standard playbook, refined and rehearsed over decades, prioritizes something called a purchase and assumption transaction, where a healthier bank agrees to immediately absorb the failed institution's insured deposits and take over as much of its operations as possible, ideally over a single weekend, so that when the assuming bank opens its doors Monday morning, customers can access their accounts almost as if nothing happened. This isn't improvisation, it's a deliberately engineered process. The FDIC typically identifies and pre-qualifies potential bidders in advance. Once a failing bank is closed on a Friday afternoon, regulators work through the weekend valuing assets and negotiating terms, and the goal is to have a new institution ready to open branch doors by the following business day. For deposits within the insured limit, this transition is usually seamless. Insured depositors of the failed bank essentially become depositors of the assuming bank overnight, with no interruption in access. Given the sheer size of the hypothetical failure Sarah is living through, though, regulators would almost certainly need to invoke something called the systemic risk exception, a special provision that allows the FDIC to bypass its usual least cost resolution requirement, specifically when a failure is judged severe enough to seriously threaten the broader economy, opening the door to more extraordinary measures, like guaranteeing deposits above the normal insurance limit, exactly as happened with SVB and Signature Bank in 2023. Layered on top of the FDIC's resolution machinery sits an entirely separate set of tools controlled by the Federal Reserve, whose original 1913 mandate specifically included acting as a lender of last resort during exactly this kind of crisis. Under normal conditions, healthy banks can already borrow from something called the discount window, pledging Treasury securities, mortgage-backed securities, or other qualifying collateral in exchange for short-term loans designed to bridge temporary liquidity gaps. During genuine emergencies, the Fed can go significantly further, invoking a provision known as Section 13.3 of the Federal Reserve Act, which allows the central bank to extend credit under what the law calls unusual and exigent circumstances, provided at least 5 members of the Board of Governors vote to authorize it. This exact authority is what allowed the Fed to stand up dozens of emergency lending facilities during the 2008 financial crisis and the COVID-19 pandemic, and it's also what produced the Bank Term Funding Program, created within days of the SVB collapse specifically to give other banks a safety valve so they wouldn't face the same fate. The entire point of these tools, layered together, is to inject liquidity into the system fast enough that a solvency problem at one institution doesn't metastasize into a liquidity crisis across dozens of otherwise healthy ones. None of this happened by accident or good luck. It exists because lawmakers spent years after the 2008 crisis specifically engineering a regulatory structure meant to prevent, or at minimum contain, exactly the kind of scenario Sarah is now living through. The 2010 Dodd-Frank Act created an entire enhanced regulatory tier specifically targeting the largest, most interconnected banks, the ones regulators consider systemically important enough that their failure could genuinely destabilize the whole financial system. Under this framework, banks holding $250 billion or more in assets face mandatory stress testing, meaning regulators periodically simulate severe hypothetical scenarios, a sudden recession, a real estate crash, a spike in unemployment, and require these institutions to prove on paper that they hold enough capital to survive it without collapsing or needing a bailout. The 8 banks large and interconnected enough to be formally designated global, systemically important banks face the single strictest tier of this oversight, including required living wills, meaning detailed contingency plans, explaining exactly how the institution could be unwound in an orderly way if it ever did fail. Precisely so, regulators aren't scrambling to improvise a plan from scratch in the middle of an actual crisis. This is the layer of protection Sarah's advisors mean when they later explain to her that modern banking includes multiple overlapping safeguards, specifically designed to reduce the odds of a catastrophic, uncontrolled collapse, even though, as any honest regulator will tell you, no system can ever be made completely failure-proof. There's also an international dimension to a failure this large that rarely gets discussed outside specialist financial circles, but that becomes immediately relevant the moment a bank of this size actually goes under. Because the dollar functions as the world's dominant reserve currency, foreign banks around the globe frequently need short-term dollar funding to keep their own operations running smoothly. And during periods of acute stress, that funding can suddenly become difficult to find in private markets. This is exactly why the Federal Reserve maintains standing currency swap lines with a handful of major foreign central banks, arrangements that let those central banks exchange their own currency for dollars and then lend those dollars onward to banks within their own jurisdictions. During the COVID-19 pandemic, usage of these swap lines peaked at nearly $450 billion as global dollar funding markets seized up almost overnight. A vivid illustration of just how quickly stress inside the American banking system can ripple outward into economies that have nothing directly to do with the institution that actually failed. A collapse at the scale Sarah is living through would almost certainly trigger a similar international response, with foreign regulators and central banks watching just as closely as their American counterparts, precisely because so much of global trade, lending, and investment ultimately clears through the American banking system in one way or another. Meanwhile, the ripple effects Sarah is watching play out across domestic financial markets follow a pattern that's shown up again and again throughout banking history. Shares of other large banks typically fall in sympathy during moments like this, not necessarily because those other institutions are in any actual danger, but because investors, understandably spooked, start selling first and asking careful questions later. During the SVB episode, this exact dynamic hammered regional bank stocks across the country for days, even though the vast majority of those banks had no meaningful business overlap with SVB whatsoever. They simply got caught in a wave of indiscriminate fear. Borrowing costs tend to rise during these episodes as lenders grow more cautious. Companies quietly shelve expansion plans and hiring decisions until the uncertainty clears, and investors as a group tend to rotate money into traditionally safer assets like government bonds, a pattern researchers sometimes call flight to quality. None of this means the entire economy grinds to a halt, but it does mean the disruption reaches meaningfully beyond the walls of the failed bank itself, touching businesses and households who never had a single dollar deposited there. To understand just how severe a truly systemic bank failure can become, it helps to look at what actually happened during the broader 2008 financial crisis. Since WAMU's collapse didn't occur in isolation, it was one domino among several. Lehman Brothers' bankruptcy filing on September 15, 2008, remains the largest corporate bankruptcy in American history, and the shockwaves it sent through short-term lending markets were severe enough that the Federal Reserve felt compelled to establish an entirely new emergency facility, the commercial paper funding facility, within weeks, specifically because an entire segment of the short-term corporate funding market had essentially frozen solid overnight. Investment banks, unlike traditional deposit-taking banks, had spent years funding themselves largely through these short-term markets rather than customer deposits, which meant that when confidence evaporated, they had almost no stable funding base left to fall back on. This is precisely why Bear Stearns collapsed just months earlier in March of 2008, and why Merrill Lynch was hastily absorbed into Bank of America the same weekend Lehman failed. 3 major Wall Street institutions effectively disappearing within a span of roughly 6 months. Sarah's hypothetical megabank, unlike Lehman or Bear Stearns, would be a traditional deposit-taking commercial bank rather than a pure investment bank, which is actually significant because deposit-funded banks are generally considered somewhat more stable than institutions dependent entirely on short-term wholesale borrowing. Even so, the broader lesson from 2008 remains directly relevant. Once panic reaches a critical mass, healthy-sounding balance sheets and reassuring press statements from regulators often aren't enough to stop a determined wave of withdrawals on their own. Decisive, credible, and fast intervention is what ultimately restores confidence, and the speed of that response matters just as much as its substance. This is exactly why the living will requirement embedded in Dodd-Frank matters so much for an institution the size of Sarah's bank. Every global systemically important bank is legally required to submit and periodically update a detailed resolution plan explaining precisely how it could be unwound in an orderly fashion if it ever failed. Essentially, a pre-written playbook regulators can pull off the shelf rather than improvising one during the most chaotic hours of an active crisis. These plans cover everything from which subsidiaries would need to be sold first, to how the bank's technology systems could be separated from its failing parent company without freezing customer access to accounts, to how derivatives, contracts, and other complex financial instruments would be unwound without triggering a broader market disruption. Sarah's own experience over the following days mirrors exactly what financial advisors have been telling business owners since the 2023 regional banking crisis, sometimes described as one of the single clearest lessons to emerge from that entire episode. A widely cited statistic from that period found that 55% of small businesses relied primarily on a large bank for their financial services, while 43% used a smaller bank. And in the aftermath, financial advisors across the country began urging business owners, almost universally, to stop concentrating their operating cash inside a single institution. One technology tax partner interviewed at the time put it plainly, that this was simply a good moment to reevaluate banking relationships and diversify assets across multiple institutions, rather than trusting any single bank, however large or reputable, to be an unshakable foundation. Consultants who worked directly with panicked SVB clients during that chaotic weekend later noted that nearly every one of their clients emerged from the experience actively building out a genuine portfolio of banking relationships, rather than relying on one primary account and specialized tools like the Certificate of Deposit Account Registry Service, which automatically spreads large deposits across a network of participating banks to keep each slice under the insured limit, saw a meaningful surge in interest specifically because of episodes like this one. One particularly sharp insight that emerged from later analysis of the SVB collapse deserves real attention here, because it complicates the comforting assumption that simply opening a second bank account solves the entire problem. Researchers studying the aftermath found that many companies who believed they had already diversified their banking relationships discovered, only once trouble actually arrived, that they'd really been relying on a single point of failure all along, whether that was one dominant operating bank, one primary payment processor, or one critical vendor relationship sitting quietly underneath several seemingly separate accounts. True resilience, in other words, isn't just about opening accounts at multiple banks on paper. It's about actually testing, in advance, whether those accounts are functionally independent enough to keep a business running if any single one of them suddenly goes dark. One especially uncomfortable detail that emerged from deeper analysis of the SVB collapse deserves attention here, because it complicates the comforting assumption that opening a second account automatically solves the entire problem. Researchers examining the aftermath found that companies with operating accounts, credit lines, and venture capital banking relationships, all concentrated at SVB, discovered only once trouble actually arrived that they had effectively no fallback at all, since every financial relationship they thought was separate turned out to be tangled together inside the same failing institution. One analyst who studied the collapse afterward drew a pointed comparison to cloud computing outages, noting that companies which believed they'd diversified their technology vendors often discovered they were all quietly running on the same underlying cloud provider once that provider suffered an outage, and banking concentration risk works in an almost identical way. True resilience, in other words, isn't simply about opening accounts at multiple banks on paper. It's about actually verifying, well before any crisis hits, that those accounts are functionally independent enough to keep a business running if any single one of them suddenly goes dark, meaning separate payment processors, separate points of execution for payroll, and separate credit relationships, rather than several accounts that all quietly rely on the same underlying infrastructure. Sarah's advisors, once the immediate crisis passes, walk her through exactly this kind of stress test, mapping out every single financial dependency her company has, not just where the money sits, but which processor moves it, which payroll provider touches it, and which credit line backs it up if operating cash gets frozen even temporarily. There's a psychological dimension to all of this that deserves just as much attention as the technical mechanics of resolution and regulation. Behavioral economists who study banking panics describe a specific and remarkably consistent pattern that once depositors start doubting whether they can access their own money, rational calculation about actual risk tends to matter less than raw uncertainty itself. During the SVB run, plenty of depositors who intellectually understood the bank was likely to be rescued in some form still pulled their funds immediately, reasoning entirely sensibly from their own narrow perspective that the cost of being wrong about a rescue was catastrophic, while the cost of moving money unnecessarily was merely a minor inconvenience. Multiply that individually rational calculation across thousands of depositors simultaneously, and you get exactly the kind of self-reinforcing stampede that took SVB from stable to closed in under 48 hours. Modern communication technology has only accelerated this dynamic. Where a 1930s bank run required depositors to physically stand in line outside a branch, today's bank run can unfold entirely through smartphone banking apps and group chats, with rumors and withdrawal instructions spreading through social media and messaging platforms faster than any official statement from regulators can possibly counter them. Some economists who studied the SVB episode specifically flagged this as a genuinely new feature of modern banking panics. An institution's fate can now be sealed within hours rather than days, which is precisely why the Fed and FDIC have both emphasized in the years since that their own response times need to compress just as dramatically to keep pace. As the days pass in Sarah's ordeal, regulators announce that customer accounts and essential operations are being transferred to a healthier institution, following almost exactly the choreography that's played out in every major bank failure of the past 2 decades. Within a matter of days, Sarah is able to process payroll again, pay her suppliers, and resume something resembling normal operations, even as broader stock market volatility lingers for weeks afterward in international investors, keenly aware of how deeply the American banking system is woven into global finance, watch developments closely from overseas trading desks. Looking back on the entire episode once the immediate crisis passes, Sarah arrives at the same conclusion nearly every serious student of banking history eventually reaches, that the single greatest danger was never really the failure of one institution in isolation. It was the sudden, contagious loss of confidence that failure threatened to unleash across a system that fundamentally runs on trust. Banking, at its core, is an act of collective faith. Depositors hand over their money because they believe, without really thinking about it most days, that it will be there when they need it. Businesses extend credit because they trust that lending markets will remain open, and investors buy assets because they trust that markets will keep functioning in an orderly way. When that quiet background trust gets shaken even briefly, the effects ripple outward far beyond the walls of Wall Street, reaching small business payrolls in Charlotte and grocery budgets in towns most bank executives will never visit. The experience permanently changes how Sarah manages her company's finances going forward. Rather than trusting a single institution with the entirety of her operating capital, she now spreads deposits across several banks of varying sizes, maintains a dedicated liquidity buffer, specifically earmarked for emergencies, and reviews her financial contingency plan on a fixed schedule, rather than only thinking about it after a crisis has already begun. She understands now that this kind of preparation was never really about expecting the worst-case scenario to materialize. It's about building enough structural redundancy that if it ever does happen, the disruption becomes a serious inconvenience rather than an existential threat to 62 families depending on a Friday paycheck. In the end, the failure of America's largest bank would unquestionably rank among the most significant financial events in modern history, the kind of moment that reshapes regulation, reshuffles public trust, and gets studied in economics classrooms for decades afterward. It would generate real volatility, meaningfully slow economic activity in the short run, and test the public's faith in a system most people never think about until the exact moment it stops working the way they assumed it always would. But it would also trigger an extraordinary, deeply rehearsed response from the FDIC, the Federal Reserve, and policymakers across the political spectrum, all specifically engineered over the better part of 2 decades to prevent one institution's collapse from dragging the entire economy down with it. The biggest lesson embedded in all of this reaches well beyond any single bank's balance sheet. Banks are more than buildings holding money behind a counter. They're the quiet infrastructure that allows paychecks to clear on time, mortgages to close, small businesses to make payroll, and an entire modern economy to keep moving without most people ever having to think about the machinery underneath it. When confidence in that machinery gets shaken, the effects genuinely do reach far beyond Wall Street trading floors. And yet history, including the imperfect but ultimately successful containment of the 2008 crisis and the remarkably fast resolution of the 2023 regional banking turmoil, has shown again and again that strong institutions, layered regulation, decisive intervention, and the deliberate rebuilding of public trust are exactly what allow a financial system to absorb even its most severe shocks, and eventually come out the other side still standing. There's a final, quieter lesson buried inside Sarah's story that applies just as much to an ordinary household as it does to a 62-person logistics company, and it has almost nothing to do with predicting the next crisis correctly. Nobody, not the sharpest economist, not the most experienced regulator, not the bank's own risk management team, reliably predicts exactly when or how the next major financial shock will arrive. Washington Mutual's executives didn't believe their institution would collapse within 18 months of reporting record profits. Silicon Valley Bank's leadership was reassuring investors about the strength of their balance sheet mere days before a 60% stock collapse. The pattern that repeats across nearly every major financial crisis in modern history isn't that warning signs were completely invisible in hindsight. It's that the people closest to the problem consistently underestimated how quickly confidence could unravel once cracks became visible to the wider public. This is exactly why the practical lessons Sarah eventually adopts matter so much more than trying to predict which specific bank might fail next. Spreading operating capital across genuinely independent institutions, verifying that backup accounts aren't secretly tangled together through shared processors or shared credit relationships, keeping a liquidity cushion sized for weeks rather than days, and building a written contingency plan before a crisis rather than during one, none of these steps require correctly forecasting the future. They simply require accepting that the financial system, for all its regulation, oversight, and hard-won stability since 2008, still runs on a foundation of trust that can shift faster than most people expect, and that the businesses and households who weather these moments most comfortably are rarely the ones who saw it coming. They're the ones who had already built enough redundancy into their financial lives that a single point of failure was never going to be enough to bring them down.